All right, I'd like to welcome everybody to the town hall meeting. We now have a new president. It's not president-elect anymore. The inauguration, I thought, went very well compared to what a lot of people thought. And I'll probably comment on that a little bit later. And I'm going to go ahead and turn the beginning part over to Miss Deanna. If you'd like, Deanna, we'll allow you ladies to go first
Sure.
tonight to kick off today's town hall meeting. I think this is the first one in
Oh,
2000.
wow. Is it? No, I thought we had one the first week.
21. No.
I'm not, on that, but you look at it and go, do you realize for the next 9 days, 121 of 21 is the exact same thing if it's forward or backward?
Uh,
129 of 21 will be the exact same thing, forward or backwards also. Just little things that I think up,
yeah, we're stuck in analysis right now, aren't we? Yeah.
but it's the same number forward or backwards. So Deanna, I'm going to go ahead and turn the first part of the town hall over to you.
Okay. Well, Happy New Year, if we haven't already said that. We're seeing, of course, a lot of speculation in the markets, as always, the noise. And if I have one profound piece of advice, as we always say, is to ignore the predictions about what the market will do. And that's difficult to do, even for us. I mean, we're sometimes have our heads buried in academics about some of this stuff and trying to determine what the economists are modeling for us. But here's an interesting thing to consider. We have to do a lot of probability analytics when we're doing financial planning, which is an ongoing and continuous process because we can't predict, we can only plan. And we have to look back to find models and maps to have a guess, a framework from which to project forward. But again, it's not a prediction, it's a probability analytics. So we're looking forward. And our job basically is, and first and foremost, is we have to build financial resilience for our clients so that they can thrive in the good times and survive the bad. So right now, what you're going to hear all over news and economic outputs is recovery statistics, and then they're going to be arguing with if we're in a bubble or if the certain stocks are overvalued, and none of that is incorrect, but none of it is correct either. It's just not complete. And the challenge is we've never been here before. We don't have a model for a global pandemic combined with the type of fiscal and stimulus response that we've had from our government. That's unprecedented as well. So even comparing it to past pandemics, there's an information gap there. So that's two things going on. And we also are starting to realize, the interconnectedness of the global economy and how the pandemic is affecting supply chains and distribution and transportation, and even the types of goods and services that we used to import or export are now staying local for necessity. There's just so many different variables going on. So I caution you to buy into any of the estimates of this huge growth, but also caution you to be fearful of this huge crash. The speculation surrounding, we talked about this last town hall, was, the speculation that's going on with things like Bitcoin and Tesla and all these other things. People become, entrenched in these opportunities to make a quick buck. And that's speculative gambling. That's not investing, and that's certainly not prudent planning, especially at this stage. As you know, we primarily work with folks that are protecting what you've saved so that you can enjoy your assets and spending your assets to enjoy the life that you planned for to live someday. Today is someday. So a lot of this is being driven too by what's going to happen with the vaccine. It's a race to see what's going to happen, and they can only guess. They're making educated guesses, yes, but it's a guess, and the recovery across various areas is going to largely depend on that. So we are seeing some of the resiliency in our own economy as well. I mean, consider some of the work automation and the digitization of the economy that has just transformed the way we're doing business right now. I don't think we're going to see a return to the way things used to be. I think that the lockdowns have really identified new opportunities and ways to be doing business. And so how will that impact us long term? It's hard to know. But here's something I read today that, again, these opportunities, there's progress right now on an LED version of UVC. And what this means is it's not just a COVID killer, it stops all viruses and bacteria. So think about E. coli or common colds. So we will have a combination of visible and invisible light bulbs to use in homes and offices, on the back of stadium seats and other public venues. I mean, think of the leap forward we've made just with that kind of technology when it's ready for actual implementation. How many people die from infections and viruses every year? So that's a game changer. So there's a lot of really good things that are coming out of challenges, as always. I'll leave you with this, some paradoxes in our financial planning lives before I turn it over to one of the other folks. Is a 65-year-old retired woman has a longer investing horizon than a toddler has for college. Think about that for a minute. A 65-year-old woman must plan for a 20-year horizon for just normal longevity expectations, life expectancy. How many folks do we know in their 90s? So that's even conservative. The baby's going to hit college in 18 years. So the takeaway from that is most of us must invest some, if not most of our money for the long term. So these short-term fluctuations, yes, 2020 has been challenging, but we're not going to chase the gains. We're going to protect from major losses so we can protect your income today and into a long and enjoyable future. So with that, I'm not sure who wants to go next, if it's Mel or Steve.
We'll go ahead and pass it over since he's already muted. Thank you very much, Miss Deanna. Since he was already unmuted, we're going to go ahead and transfer it over to Mel.
All right. Well, thank you all for being here tonight. I'm going to see if I can get this to work properly and share a screen with you. Is that coming through on how to deal with emotional retirement? Okay. These are some things that I found on the today about retirement planning, that it has nothing to do with investing or what you should be invested in or things of that nature, but a little bit more about where we find ourselves when we're close to retirement and what some of the issues are. You know, how do you deal with the emotional retirement? Steve and I see this a lot. It is, and we tell people, it's a huge adjustment to I'm working, I'm saving, I don't care. I buy whether the market is up and down in my 401k, that's dollar cost averaging. I have a paycheck, I know what I live on each month. Okay, I'm out of work. I don't have a paycheck. There are a lot of things too. What do I do with all that time? You can expect to go through some emotional stages. One of the things to do is, structure your days, have a pattern built up of some kind, set some small goals. We laugh a lot. There seems to be, for the guys, there's always these big honeydew projects, but they run out after a period of time. And you can't use the excuse that you're too busy anymore. So we have to jump in on those things. Grow your friendships, spend more time with the people you like being around. Consider not necessarily, you don't even have to worry about a paying job sometimes, but something you really, really want to do. Or even volunteering work. Volunteerships are great. And also, you really have to work on a budget. This is not something you had to do while you were working. You had this much money coming in, you knew it was going to come in, and we just kind of spent what we spent. We had things to do and there was money to pay for it. When we're in the situation where we're creating our own income streams, we have to be a little more cognizant of what are our expenses. There's the need and the want. Make sure we have the needs covered, and then we can work on the wants. See if I can get this thing to work now. All right, oh, I went too fast. Sorry about that. What do retirees worry about? This was some really interesting numbers. 72% are worried about running out of money. We kind of known that for a long time. 57% are overwhelmed by determining how much can they spend. What can I afford to spend my money on to be able to be retired? And what affects that decision so much depends on whether you have a structured income or an invested income. Invested income means you depend on the market to produce the asset, the income for you, versus you have structured income like Social Security, pensions, fixed income products, life insurance products that pay out incomes, things are going to be there whether the market are up or down, versus the market has to do well for me to do well as far as income goes. So that's a really big deal. 60% are worried about not getting, or the thought of not getting, a regular paycheck. Which pocket do I spend the money out of? Where's it coming from? When do I sell which asset and in what order? And that does make a huge, huge difference as to how long your money will last. That's one of the things we spend a lot of time on is income planning and structures. Now, 64% are overwhelmed by not being able to maintain their current lifestyle or the quality of life. Not so much that they can't, but not knowing whether you can or you cannot. What are some of the consequences of being ill prepared for retirement? Quite simply, the main consequences of not planning for retirement is loss of control of your future. Transamerica Retirement Survey shared that 44% of those surveyed are afraid of outliving their money. With that type of fear hanging over your head, it's pretty difficult to sit back and enjoy your retirement. So one of the things we spend a lot of time on, and we would encourage you, if you haven't already done that, most of our clients, this is something we do regularly, but if you're not a client and you're seeing this particular presentation, you absolutely need to be more concerned about income structures, taxation, when to use your assets and in what order. That's more important, quite honestly, than what stock, bond, or mutual fund you might be invested in. So we do encourage you to spend some time getting comfortable with, can I live my retirement in the style that I wish, and not worry about what the market's doing this year or next year. What are the two risks of private retirements that could deprive you of a sufficient income in retirement? In other words, if the majority of your retirement income is coming from your personal investments as opposed to, say, Social Security or pension. Well, financial risk include inflation. We find that people are absolutely shocked sometimes when we build out a retirement plan and an expense plan that includes a 2 or 3% inflation rate over time. And what's interesting, the national average of inflation is only like 1.5, 1.6, somewhere like that. But for retirees, it's closer to 3.5% because of health issues and having to pay for more things that we used to do ourselves. It's actually a more inflationary environment being retired than it was while you were working. Poorly performing retirement plans can have a really, really big effect on that. Public policy risks include the possibility of higher taxes and the reduced benefits from Medicare and Social Security. We're constantly concerned about what's going to happen to Social Security in the future, what's going to happen to Medicare. What most people don't realize is that Medicare is way, way bigger than Social Security by a factor of about 5 times. That is a much bigger governmental expense than Social Security. Social Security is essentially a self-funding payment through revenue and the so-called slush fund that they have. The slush fund is liable to be gone in the next 5 to 10 years, and they may have to reduce benefits or increase taxation on Social Security to make sure that the revenue is there. Because one thing Social Security can't do is it can't pay out money it doesn't have. That's not the same as Medicare, where they can just print the money. It's a little bit different situation altogether, something to be aware of. What's the safest investment for retirees? Now, keep in mind, safest doesn't necessarily mean the best or what you should be in or what will make you the most money. These are the items that would give you the most surety. No investment is completely safe, but there are 5 banking savings accounts like CDs, treasuries, money markets, fixed annuities. There are considered to be among the safest investments that you can own. Bank savings accounts and CDs are typically FDIC insured. The others are not government insured, but they are insured through the insurance industry. So if I wanted to have some of my money in a safety environment where I can't get affected negatively due to market fluctuations, those are the 5 things that should be mixed in with your overall portfolio. So that is the end of that particular presentation.
Thank you, Mel. And we'll go from there. I'm going to kind of touch on the current events. You know, as I said earlier, I thought that the inaugural speech was one of the best ones I've heard. I just pray that almost all those things can happen. I hope that we come together as Americans versus red, blue, Democrat, Republican, to do what's best for the entire country, as I hope those things happen. I was very, very, very glad to see that we had no unrest at capitals. You know, there were predictions that all 50 states were going to have problems in their state capitals. To my knowledge, that did not happen, which I was very, very glad to see that. Some of the things that did start out immediately, back into the Paris Accord, the stopping of the XL pipeline. A lot of these things are being done by executive orders. And I know that kind of happened a couple administrations ago, and then it happened again during the Trump administration. And I'm kind of praying that we don't get to the point where our country is ran by the pen of the president. But I'm hoping we do what's best for the country. One of the things when I made a trip to Washington, D.C. about 6 to 7 years ago, that I learned from an inner city, Kansas City legislator, he said that we don't talk to each other in Congress anymore. Everybody remembers the bridge to nowhere. It was about pork within the U.S. budget. And what was pork for one area was a necessity for a different area. That bridge to nowhere went to an island in Alaska that the people on that island for almost 3.5 months could not get on or off of that island because the ice wasn't thick enough to do it. So for those people, that bridge to nowhere was not a bridge to nowhere. It was the availability to get on and off the island. Now, here in the state of Missouri, we want to bring in business for the Anheuser-Busch's, the Monsantos, the Boeings. That's a necessity for us. But if you lived in a state like Tennessee, that would be considered pork. So the idea around it of it is what I learned from those legislators, that our people in Congress don't talk to each other anymore. So if you see that legislation that comes back in to allow some of the spending expenditures on bills attachments, again, what's pork in one area is a necessity in another area. They said that at that time it was less than 0.5% of the US budget. But the congressman said they didn't talk to each other anymore. There was really no need to. There was no sense for one guy to cross the aisle and speak to the person on the other side of the aisle. And I believe that we need that back in our government. We need plans that are brought together by one party and the other party. It's not one side says it, the other side either disagrees or agrees to it. So I'm hoping that we get a lot of that coming in. I think that President Biden has a lot of headwinds that are hitting him right now. You know, we do have the coronavirus, which I don't think's going away because the inauguration was on Tuesday. But we look at it and sit here and say that we have these things that are happening. We need to look more forward. Jobless claims this week were still at 926,000 people lost their jobs. With the stopping of the pipeline and the stopping of the building of the wall, many jobs will be lost during that portion of it. We have to look at it and sit here and say, what can we do? The mandate to wear a mask, whether you agree or disagree with it, let's try it. Let's try it. Let's try to move forward as Americans as we go. The PPP loans for small businesses has been approved again. That has now been available. They made it available for almost a week to 10 days for smaller businesses, predominantly minority. This time there are more strings attached to it than there was the last time, which I was glad to see. It's based on, did you get the first loan? And if you did, if you had business declines of 25% or more, that you would have the opportunity to get those loans. Restaurants and things of that nature went to the front of the list because they are the people that probably have been hurt the most during the pandemic. So I would like to again say there's plenty of headwinds. I think we as Americans can come together in unity to do what's best for the United States of America. And I think in the long run, that will assist everybody in their retirement. If you have any questions about the merger between Brookstone and RWA, please don't hesitate to give me a call. We have moved some clients to the TD Ameritrade platform. A lot of the clients that are currently on the Fidelity platform have moved to a different model. We're hoping to have the availability to use the sleeves of the Brookstone models. We're hoping to be able to do that near the end of February, the beginning of March, might be slowly after that. If you've got questions about your portfolio and Chris has not already contacted you for your quarterly review, please don't hesitate to give us a call. Let's get together. Let's sit down and talk about how we could possibly change your investment structures to meet your needs. Because that is one thing that I do like about the merger. We have a lot more ability to deal with our clients. We can be moderately conservative or moderately aggressive, and then take a small piece of it, gear it to income, gear it to defense because we want to protect that portfolio. Or we can do it to very aggressive growth without making the whole portfolio aggressively gross. So I want to again thank everybody for the referrals we got in 2021. We've had people refer their friends and their family, and that is one of the greatest compliments that we can receive as a company. We want to thank you for that. And I am going to go ahead and stop the recording now. Again, if you have any questions, please don't hesitate to give us a call. If you've never talked to us before, the reviews are complimentary. As some people say, Steve, I can't get a second opinion until I get a first opinion. So if you need either one of those, please don't hesitate to give us a call so we can sit down and see what we can do to help you with your retirement platform.